in case you wanted to know that. I think the most important thing before we kick it off is to introduce yourself in the chat. I know Judy Lee Greenhill has already introduced herself when we were in the prior meeting, and feel free to let us know where you are, who you are, what you do, and why you came to this conversation. And please know that while we set this up as a Zoom webinar, the intention was to be able to have an engaging conversation. So please do use the Q&A function or raise your hand, and there will be ample time for questions. So just kicking it off, I'm Eva Yazhari. I'm the general partner of Beyond Capital Ventures, and I'm really happy to be here with Victoria, with Gale, with Barbara, whom I will introduce in a minute. But today we will be speaking about how early stage managers are really changing venture and what GPs, LPs, and founders should really know. If you spend time in the emerging manager space or even in the venture space, there is a lot of talk about how this space is evolving and about how there is funding, it's questionable, going to emerging managers. And regardless of whether that the funding is actually flowing where it needs to, what we really wanted to bring you was a conversation about what is actually changing and what you should know, whether you're an investor, whether you're a GP yourself, or whether you're a founder and you're raising money from some of the funds like ours. So with that, I'm gonna just do some quick introductions of our panelists, and then we will take it forward with some Q&A. So first off, Gale Wilkinson. She's the founder and managing partner at Vitalize, a seed fund and angel community investing in the future of work and learning software. Previously, Gale founded Irish Angels, one of the largest angel groups in the country. Incredible. And Gale has led $65 million plus in early stage deals across 80 portfolio companies. Her experience prior to VC includes founding 2 failed startups, consulting for new product launches with Nielsen, and strategy with Orbitz. Welcome, Gale. So great to have you today.
Thanks.
Next, over to Barbara Iyayi. She has over 16 years of experience spanning VC, fintech, private equity, investment banking, M&A, and technology. She is the CEO and founding partner of Unicorn Growth Capital, a women-led VC firm investing in the future of fintech. Barbara previously served as the Chief Growth Officer and Managing Director of Africa of Element, Inc. And she was part of the inaugural team of Atlas Mara and was VP of Investment Banking at JP Morgan and UBS. Welcome, Barbara. Great to have you.
Thank you, guys.
And last but not least, Victoria Pettibone. She's an active investor and advisor in the innovation economy and managing director of Astia, a global organization that levels the investment playing field for entrepreneurial teams with women leaders. As MD, Victoria is one of the 4 members of the investment team for Astia Fund, a $100 million venture fund investing in early stage women-led companies. Victoria's personal portfolio of investments includes over 20 female-led businesses. Super impressive. Victoria, thanks so much for being here.
Thank you. This is great.
So this is a conversation that we will also turn into a written piece for The Conscious Investor, an online magazine that spotlights social impact, conscious living, and has been recently doing a series on women in VC. But let's just kick it off. Let's talk about kind of the state of venture capital funds today. There are more VC funds really than ever, and now here in 2021. In the US alone, there are 3,680 VC funds with $548 billion in assets under management. And these are all active as of the end of 2020. So in today's conversation, we're really going to focus on early stage venture, typically funds that are less than $100 million in size. And in a given year, around 55% of all VC funds are considered early stage VC. So this should be exciting news for the founders, as there really are more opportunities to receive funding, particularly our funds, which I think have different lenses of potentially funding underrepresented groups. But I want to start by really better understanding what it means to be an early stage VC. And so let's unpack maybe the things that wouldn't be obvious to those who are on this in this conversation. I'll start with you actually, Victoria. In your opinion, really, what are the advantages of being a smaller VC fund? I mean, $100 million is still, substantial, but, in the world of Andreessen Horowitz, et cetera, these are smaller pools of capital. And what might be some of the implications for the founders looking for capital from a fund like yours?
Well, thank you for the question. I mean, being an early stage VC, I think is the most exciting place to be because you are able to get in at the ground with the companies. We're focused on Series A and Series B, so even a little beyond where some of the early stage funds participate. But still, we're right at that point when everything is, that big inflection point that's happening, and there's so many critical decisions being made, and we are able to be there by the side of the entrepreneur, advising, opening doors, making recommendations, bringing in other advisors in, and they're still, still very much about that core team, and really adding water to a really exciting progress that's been made to date. So the other thing that is amazing about being at this stage is that we see women founders, we see underrepresented founders. Because we are able to, they haven't hit that wall yet where there's no funding. We're there at that early stage to provide the funding. So a much more diverse set of founders to invest in and work with. So I'll start there because I know Gale and Barbara have lots to add. Pass it over.
Yeah, Barbara, you are shaking your head. What would you add here?
Sorry, I was on mute. No, I think that's absolutely right. One of the biggest things we provide as emerging managers is we just have a different game plan, right? Compared to some of the larger funds. I think in ecosystems that are just developing, I think we're even more powerful, right? So if you think about both in the US, there are all these new diverse ecosystems being formed in Atlanta, in Texas, in all these different areas. Emerging managers are at the center of that, right? Like the larger funds wouldn't have built that. So it's like, if not for emerging managers, we wouldn't have seen the proliferation of those type of ecosystem. And then internationally, and Eva, you know this, in continents, frontier markets, in Asia and Africa, emerging managers were at the forefront of developing those ecosystems. And that's what I'm doing in frontier markets like in Africa. So I think there's a fundamental difference in approach that and requirement that emerging managers are bringing to the ecosystem in enabling the ecosystem in these underserved developing ecosystems. So yeah, I just wanted to add to that.
And I know, Gale, maybe you want to hop in on the value piece, but it provides value to the investors. So what LPs need to know is that this set of VCs is truly driving opportunities that they can't reach otherwise. And I think that's an excellent point, Barbara. Gale, do you want to jump in with any comments on this question?
Yeah, I think that's right. I mean, there's such alpha in the group of emerging managers that's managing these smaller funds or earlier funds because, for example, our organization, we have over 600 co-investors in our database. And the last time they looked at the data, over 60% were underrepresented co-investors. And what that does is our networks of deal flow are so broad and diverse and varied that there's real richness there that I think some of the larger firms are just missing out on. And so there, to your point, there's that value being added on the investor side. And then also on the founder side, something we haven't touched on yet, which I think is really important, is like, I've had women, I've had people of color, I've had LGBTQ plus individuals tell me like, it's so nice to see somebody sitting across from me who doesn't look like every other investor. And even if I'm still different than they are, like they recognize that I'm a minority in this world, and that allows them to feel comfortable. And I think that they really get a lot out of those conversations. So that representation is just really critical for the founders.
Yeah, so this dovetails into another question I wanted to just touch on, which is part of why early stage VC is really changing is because we've all said it's a different game plan. It's a response to a more traditional Silicon Valley, this is my take, view and model of investing. And some really may ask, well, why does this model actually need to change? But Gale, your point, I think about inclusion and moving beyond this purely like, it all looks the same. I show up with the money, you're the company, you're going to do what I say, transactional mindset, I think is something that emerging managers do really bring to the table. At least we've really rethought that at Beyond Capital Ventures in giving a percentage of the general partner profit share to every founder in our portfolio. So let's take a step back and just maybe kind of talk a little bit more about what are some of the core maybe reasons or philosophical reasons even that there is a need for a founder to point out that you look different than other investors, Gale. And I'll start with you. What is actually motivating us all to really think differently about how the alpha we bring, but also the kind of different game plan that we bring to the table as emerging managers?
I think we've had incremental change so far where, little by little, some more founders will get funding and then they have exits. And then there's a little bit more angel capital to go into the system. And so you continue to see the incremental changes. But what's happened is that there have been enough founders and enough investors of underrepresented backgrounds who are now in the ecosystem. I think we're all kind of looking around and saying, okay, we need a bigger shift. And so I think it's easier to talk about this now. It's easier to speak with both the founders, with investors about what kind of change we need to see. And we're finally starting to see model shifts and new innovations coming in, like what you're doing, Eva, with giving back to founders who work with you is fabulous. This is wealth creation. These are the types of structural changes that we are starting to see in the business. And I foresee a step change coming in the next 2 years.
Absolutely. And I'll add on one more layer, which is that the world at large is really going through immense change. So it's not just, us kind of rethinking our own models of VC and being emerging managers. So it's not just us as GPs, but it's also what's around us that is happening. I mean, it's not just a global pandemic. It's not just the protest movements spurring long overdue conversations around race, equity, and inclusion, and but it extends to global warming as a threat. So maybe, Victoria, I'll turn it over to you. Do you feel that there are also behavior changes from the public informing how you're running your fund, and how are you incorporating that?
Yeah, well, what I love about being at Astia is the model is quite unique and different. So 2 things. One is Astia has been around for 20 years. It's a not-for-profit organization, 501c3. Our fund exists under Astia. Astia is the GP of the fund. And then myself and my 3 partners, the 4 of us, we all have we have incentives based on performance in the form of bonuses and all of that. So we're properly incentivized, but at the end of the day, the more successful the Astia fund, the more successful Astia, the organization, which also is doing a huge amount of advocacy work and thought leadership and other programs to support women entrepreneurs. So there's this amazing mission alignment. And then the other thing that happens is we have built a sourcing and screening process that leverages the broader Astia community, who are all volunteering time because they are mission aligned. And we're able to use a sourcing and screening methodology that is really set up to remove bias in the decision-making process. It's very data-driven, and it very much depends on this broader community of people who are values aligned. So it's really values aligned investing, and it's not sacrificing performance at all. In fact, what ends up happening is you get better performance because of all of that alignment. So I think it really, it is the time for these kinds of models. I think when we went out initially, when we first went out into the market before sort of the last crazy year and a half that we've had, there was far more skepticism. And now what I do see from the general public is a much better understanding of why this kind of model actually is beneficial and does drive performance. So it's a really exciting time to be working with new models, I think.
Absolutely. And I think the key is also, because we are, human beings, I think I've found that the interest is really lies around like, what is your alpha? What is your financial performance? I think that is a really key point to just continue to drive home. I mean, for me, impact and financial returns are sitting on an even playing field, but that's just not where everybody is. So Barbara, over to you. I mean, do you talk a little bit more about this opportunity for LPs to invest in emerging VCs? And also, you know, what do you think maybe they don't know? Like if you could shout something from the rooftops, which I'm sure all of us want to, and running our fund sometimes, to get a message across, what would that be about the value proposition?
Yeah, I mean, I think it's a couple of things. I think founders are top founders that I come across. You know, I do hear people saying, you know, the larger funds don't pay as much attention to me, right? Than the smaller funds. So I think there is definitely value in being a smaller, focused niche, whatever you call it, right? I think that's what we're trying to do at Unicorn Growth Capital, right? We're focused on fintech. We have entrepreneurial backgrounds. You know, frankly, I would love to build some of the companies my founders are building. And so we approach it through partnerships. Like, we're entrepreneurs, we want to see you be successful. And I think there's this mindset of, you know, some of the larger funds are just finance focused and they're just trying to, you know, get to unicorn status or whatever. And they're not really trying to really help these companies win in their industry and become big. I mean, they are, but that's the sense that people are expressing. And so I think it's very refreshing when they see someone who has an entrepreneurial mindset, partnership approach, underrepresented background. It's all sort of very different from what they get from the larger funds. So I think the value there, I think all of that equals value, equals returns, right? Because you are focused on the bottom line, which is to help build really innovative, different companies. And I'm seeing that in some of the companies we're looking at and how they're working with us, the type of experience they have with us versus others, and the reason why they open up their cap table. You know, I just did a deal, and you know, the founder was basically like, look, we opened up your cap table because you can help us with X, Y, and Z that no one on the cap table can help us with. I think if emerging managers have that specific approach with these founders, I think they can really win some really interesting deals. Now, the check sizes become very competitive when you start getting into the Series A, Series B, and that's a whole conversation that we have to address as emerging managers. How do we grow beyond the stage we are in, you know, over time? And I think that's maybe a separate conversation, Eva, but it's something to think about as we shape the ecosystem. How do we then follow up and make sure it becomes sustainable going forward?
I love that point. That's next level thinking, Barbara. It's really, you know, the thinking about how do we maintain fidelity to being the partner rather than just passing it on to another player that, you know, uses the old playbook. I know Gale has some thoughts around how we grow, how she was thinking about her firm and how her firm grows. You know, Gale, in our pre-conversation, this really came up that you like that your value of your fund is being a smaller fund and being a smaller product. Now, I think that was kind of like a $300 million type product, but tell us a little bit more about what you were thinking there and your logic.
Yeah, so for our firm, we're really trying to actually, as Barbara mentioned, get really focused. You see a lot of seed capital coming in from some big players right now into the market. And I think we're going to have a bifurcation of founders have to decide, do they want to go after really big rounds at really high valuations with these multi-stage firms that have a lot of resources and maybe not get the personalized attention. Plus there's signaling risk if those firms don't continue to invest. And then on the other hand will be the smaller emerging managers that have a focused industry approach or some kind of thematic approach that works for what the founder is doing. They're very entrepreneurial and they have typically a brand that founders really gravitate towards and want to work with. So when I think about where the seed landscape is going, I do want to build out a firm where we can consistently focus just on early stage. And so what that means is obviously raising a fund every few years. And we do seed stage funds, but we also want to increase the volume of deals that we do. So we just launched an angel network. So one, it helps us with our problem of we have so many great deals coming in that we need more dollars to put to work, because as a small fund, I'm constrained on capital. And then the other thing that we're hearing founders ask for, and this has probably been happening for the last 18 months, many are saying, hey, I want diverse investors on my cap table. I want underrepresented check writers. Where can I find them? Can you introduce me? And so I'm like, wow, a lot of these founders, even if they're not underrepresented themselves, are asking for it. And they literally, it's tough for them to find it. So one, I send those folks to my co-investors, but I also believe fundamentally to shift some of the issues that we face structurally within venture, it's getting more women, more people of color, more underrepresented individuals who historically haven't had access, get them to a level of comfort with writing angel checks so that they can start to build that muscle of how do I assess deals? How do I feel comfortable with risk? How do I build a portfolio so that it's easier to get into venture down the road? So our new model, last week we launched something called Vitalize Angels, which allows both accredited and non-accrediteds to invest. And it's phase one of what we hope is a community platform moving forward with literally thousands of people that invest in these really early stage deals. And we'll just listen to feedback of our investors and founders, and we may build other entities and approaches moving forward, but it's always going to be focused on pre-seed and seed stage.
Yes. No, this makes a lot of sense. And I think that there is just a calling out and a lot of demand in the system for underrepresented investors. We certainly want that in our current raise. We want more women and people of color to be our limited partners. And so to be able to cultivate that community, the community that can meet that demand, I think is really impactful and important. I want to actually pivot a little bit to, we were talking about entrepreneurial brand of our funds, but pivot to kind of more generalist and maybe more specialist. So Victoria, Astia is a generalist fund investing across sectors. I have a multi-sector approach. But Gale, you're focused, as I mentioned, on future of work and HR related technology. And then Barbara, you're focused on specifically fintech. And so how do you think these kind of multi-sector or even more niche strategies are playing out in the space? I'll start with you, Victoria. What are your LPs? How are your LPs reacting to a more generalist approach?
Yeah, I think because we have such a clear focus that the companies need to be women-led, that then we can go across sectors. And because we have that sourcing and screening process that I described earlier, where we're really leveraging expertise across a broader community, we're able to bring to the forefront the very highly investable deals, regardless of the sector, because we've had experts in that sector look and help assess the companies. And then as we go into due diligence, we have obviously the specialists that we can bring in to do those deep dives. But over the 20 years that Astia has been in existence, Astia started as an incubator, then was an accelerator, and then started investing in 2013. And throughout, when we've modeled the performance of the companies that we've brought through the sourcing and screening process and we've worked with, we always found our best performance was a model in which we're doing a multi-sector approach. And in fact, when we modeled out, well, what would have happened if we had only invested in the fintech companies? Or what would have happened if we'd only invested in med device? Our performance wasn't as high. So our system for what we're doing, we work best when we're multi-sector. Certainly not necessarily the case for others, because their different models will lead to different outcomes. But for us, that has always been the best performance. So that's the tactic we've chosen.
Yeah, I'll just respond as well as a multi-sector fund by saying that I believe that there's room in the pie for allocations to all different types of managers. But for me, it's really also about diversification and risk management in my markets. So diversifying across 4 countries: India, Kenya, Rwanda, Uganda, and then diversifying across 3 key sectors: healthcare, financial inclusion, and agriculture tools. And our kind of fund modeling and then our first fund results have really shown similarly that the blended approach really works well for us. But Barbara, I mean, being so specific in fintech, it's I think it's a space where we're going to see a lot of, double-digit multiple returns, but would love to hear your kind of focus and also what your LPs are reacting to.
Yeah, no, this is such a great question because I get it a lot. So first of all, I don't look at fintech as a sector. So I look at fintech more of a horizontal than a vertical. So I feel like we invest in across all sectors, but fintech is sort of the core thesis around each of these opportunities, whether they're fintech infrastructure companies that can be embeddable across all platforms, or SaaS plays or marketplaces in different industries, logistics, healthcare, education, but have embedded finance as a core part of what drives that industry and what enables them to win in that sector. And then we look at the traditional fintech models, like the B2C native, digital native brands. So that's first and foremost. But the second is, yes, a lot of LPs sort of say, why would you focus so much? But I think this goes back to my point about being an emerging manager. What I've realized is the brand comes into play here. My brand has always been around fintech, financial services in general. Every kind of startup that I interact with, I always have a fintech angle in whatever they're doing. And so that has just become my brand. And so from a founder perspective, that's the value add I bring. But from an LP perspective, I think in a lot of these markets, and like you're playing in, fintech is really the driving force of a lot of these markets because of these underpenetrated markets around financial services. Crypto is playing a big part in these markets versus the developed markets. It's reached leapfrogging and changing the way people are doing things in different industries. So there's this fundamental component of impact, right? I am trying to invest in that sector that enables other sectors in the digital economy. And I think that in itself, across different industries, creates some level of diversification, but more importantly, it focuses on the most important trend that's driving the digital economy in these markets. And I think that's a high return strategy that investors like, but some investors don't get it, some investors do. And I think, as you know, with this fundraising game and emerging manager game, you just have to pick the LPs who get what you're doing and can help you and add value to what you're doing. So, but it's a good question. I get it a lot. So
I'm sure you do, as I'm sure Victoria and I also get the why are you more multi-sector focused a lot. I'll turn to you, Gale, in a second. What's really standing out to me from this conversation is that as emerging managers, we actually have more freedom than operating in the old paradigm of venture. I think what I'm really pulling out of this conversation is that we've been able to rethink VC and really, understand the rules that we want to apply and then use other strategies coming from different backgrounds, et cetera. I'm sure there are some burgeoning GPs or, emerging managers listening to us today. Gale, is there any advice? Are there any challenges that you would illuminate for this group, for potential GPs looking to create their own fund and what they should know?
Oh, there's lots of things. I think I will share this piece of advice. The most important thing for any emerging manager is to be authentic to yourself. So really sitting down and understanding, why do you want to be in this industry and what is important to you and what do you want to stand for? That's the question. That's the number one question that my executive coach asked me is like, okay, in this particular situation, what do you want to stand for? And it's so helpful to stand back or step back and frame that, and really get clear on it. So that's one of the things that I love about being an emerging manager in the space. Our team stands for really great process, which you would think is table stakes out there in the world, but actually a lot of firms don't have great process. So we are transparent communicators, we are inclusive, we help our founders with connections to customers and financing sources, and we're all about building thought leadership and future of work and learning. So I know that those are our core things that we care about, that I can base all of our decisions on those elements.
Yeah, I think you bring up bringing up your coach, I think really resonates with me, because I was actually going to say that this conversation, kind of makes me think about some of the things I've learned from my coach, as you rightly pointed out, authenticity. So it was literally that exact thread. And I think that's excellent advice. Victoria, I'll turn it over to you. Any advice for GPs?
My advice, what I value so much is having partners. So some of you may want to go out and do your own, but I would not be here if I didn't have 3 amazing partners who I've been investing with since 2013. So we were doing direct investment, capital call, deal by deal, SPVs. So I know we work well together. I know under stress we work well together. We've walked away from deals together. We've had things fall apart. We've had great successes. We've gone through all of that, and I rely on them because it is a long game to play the fundraising. It's going to take a long, long time, and you're going to get beat down, and having partners there to support you and keep you going and rally and also to bounce the ideas off of. And as Gale said, staying true to what is the vision and having people who can, keep you accountable, I think is amazing. I guess if you're going to go it alone, which some people love, surround yourself by those advisors, at least. Find that troop that's going to be there with you, or maybe it is a coach, but you really want that. Don't, even if you're going to be a solo GP, don't do it alone.
There was a sub question in here on what would you look for in a partner if you have a couple qualities.
Well, I think, it's good to have a partner that doesn't agree with you all the time. Inclusion, diversity, there's a reason that it outperforms, because you have different opinions, different perspectives, different worldviews that can be around the table. So I do think there has to be some comfort with the discomfort of not always agreeing. Of course, you obviously have to have great respect for one another, and so that you can disagree respectfully. But I don't think you want somebody just like you.
Absolutely. Yes. So I'm going to ask one more question of the panel. And while I do that, just please queue up any questions that you have in the Q&A. We already have one, or in the chat. Either way, we will get to it. But I'm going to take us out of the emerging manager kind of world for a second and point out that many of the shifts and trends that we've talked about today are still emerging. And they have been yet to be adopted by more traditional VCs. So does that mean that something else needs to change in the industry to really allow for more innovation around how VC is conducted? So maybe I'm going to ask all 3 of you. I'll start with you, Gale. Funny phrasing here, but if you could have like 3 wishes and really change 3 things about the industry, what would they be?
I think it's limited partner capital being open to new trends. I think one of the things that's been interesting for me is just to learn about the institutional LP world. And, I have great respect for what these firms are doing. I think it's a hugely important part of the capital ecosystem. And I'm starting to hear some institutions say, I want to carve out a couple $100 million to invest in the emerging manager asset class. But for today, the check sizes that emerging managers look for is just too small. I am confident that the institutions that take bets on this now are going to make so much money and make a name for themselves. Is going to be awesome. So I think it would be, encouraging and sending really great energy to all those institutions out there to just, consider going against the grain of what the rest of their industry is doing on the LP side, and start taking some really interesting bets.
Absolutely. One of my wishes would be to change the nature of this transactional relationship between investor and founders. I alluded to this in the beginning of the conversation, but I think I worked on Wall Street as well. And I think the old school paradigm of, the check writer gets whatever they want really needs to change when we think about at least impact and frankly, providing ownership and to founders, if I'm thinking the VC context, but just to, those who are arguably doing some of the harder work. I will admit that the founders in my portfolio work they may not work more hours, but they certainly are solving more incredible and pressing challenges on a day-to-day basis running their businesses. And so that's something that I would absolutely look to shift, which is, again, coming back to some of the way that we run our fund with the structural innovations around equity, and giving the percentage of the profit share to the founders. Victoria, what about you? What are some wishes that you would have?
Well, I definitely echo what Gale said in terms of the LP capital. And, you know, it's interesting because the pensions, the large pensions, are so values aligned with what emerging managers are doing. Their constituents are aligned with the constituents that our founders are serving. You know, there's just, so if there could be a mechanism that would enable them to be able to fund the smaller funds, I think that would make a tremendous difference. I do get frustrated at the larger institutions that say that they're investing in emerging managers, and then, to Gale's point, you know, they have $2 billion under management and yet 150 million carved out for emerging managers. That math is not going to work. It's never going to really move the needle for the emerging managers. We just need much larger allocations. And I sometimes feel like there's a lot, we all talk about that, there's a lot of talk and there's not a lot of the money moving. So I'd like to see more of the money moving, larger buckets of money being deployed into emerging managers, and then some mechanism that enables the pensions, because I get why it's challenging to be so large and to invest in smaller funds, but some mechanism that facilitates that would be.
You got a hallelujah in the chat. Which is great. And yes, I mean, I think Gale also rightly pointed out that the institutions that really step up are going to make a lot of money. And they're also going to make an incredible name for themselves. And they're going to be the leader of the pack, and they will always be the first mover. And I think that I've watched this happen in the hedge fund industry, my past industry. Then I observed it happening to Silicon Valley Venture with the flood of institutional capital that went there. And the big ones are the big ones, and they were the first. And so I think the same exact thing will happen here. Barbara, would love your insights on what you would change.
Yeah, I think what you guys just mentioned is like the number one. Like, that just has to change. Otherwise, this conversation will keep going on. But I also wanted to just talk about, I know this sounds dramatic, but just, I think we are living in a very crazy world of lots of capital. And some of my worry is, are we as GPs doing things properly? Are we enabling bad behavior with, you know, founders and all of that? And you think about all these high valuation companies and lots of, you know, some bad behavior in the market. I do wish that we as GP kind of school ourselves a little bit better. I am surprised by some of the things I hear founders tell me that, you know, firms do to them. And, you know, a lot of it is selfish. A lot of it is just self-serving, right? Because we know what we can do to sort of really, you know, take more of the pie, right? And so there has to be more of a balanced approach as a VC. I am worried about that. And I wish we would, all the new GPs coming in, I think we should have some sort of an ethos around doing things properly, being more founder friendly, being more conscious of the type of ecosystem we're building, and things like that. So I know that sounds really, I'm not trying to make this a, you know, doom and gloom, but I do think I am seeing some of that. I don't know what anyone else thinks about it. You know, we get on Twitter and we hear all sorts of things, but I do think with new GPs, with new different sort of backgrounds people come into the ecosystem with, it's great for innovation. But then, you know, we also still need to make sure that we are all doing things with a positive mindset to what we're trying to do.
I could not agree more. And I would qualify that mindset as an abundance mindset. And it's not a mindset of a zero-sum game where when I win, you lose, or the founder loses inevitably. And, you know, VCs have been saying they're founder friendly for decades, but what does that actually mean? and truly understanding and thinking that through as a part of your investment process, I think is really important. It's something that we've tried to do at Beyond Capital Ventures. And I agree, not repeating the either the mistakes, but just the patterns of the past. And this all comes down as well to pattern matching and bias as well. And I think that breaking out of that paradigm is just really important. And we have the freedom as emerging managers to do it. Because if you were to get a job, at a big VC tomorrow, I'm not sure you'd be able to change that culture. And that's okay. But, maybe changing it from the outside is the better way. So I love that you bring that up. And Danitha Doe, who's on this call, said, she also, yes, she said, this is a huge discussion. And I absolutely agree with you in founder groups. So generally speaking, she said, we don't believe VCs when they say they're founder friendly. Let's redefine that in our own funds. So let's keep the questions coming. There are a couple, and I'm going to just kind of allocate them across our group. And we meant for this to be a little bit shorter than an hour. So we'll probably have another 5 minutes for questions. But I think we're all here for everyone. And you can find us on LinkedIn and other channels like that after the conversation. So Sanam was asking, what advice or programs would you recommend for individuals just starting the fundraising process? So there are a couple new programs like Recast or Raise Global or Plexo. Any favorites or others to add to the list? I don't have a strong opinion here. I haven't been through any of these programs myself, having had a first fund. So maybe
I've done 2 of them. I did Recast, and I'm an operator now. Here's what I tell both founders and GPs. It doesn't matter what community you choose to join, just join one or start your own. I also did Kauffman fellows, and they all are fantastic in their own ways, but they take time and they cost money. And so they're not going to be a fit for everyone. Now, some do have sponsorships, and actually Recast right now does not have a fee for anybody, which is really awesome because they have some sponsorship. But it's truly about having calls regularly with people in your boat. So in addition to all those groups that I'm a part of, I have 4 or 5 groups that meet every 3, 4, 6 weeks, depending which one it is. And there's 5 or 6 of us that join. And I've just really gotten to know other GPs that way. And that's building that community and asking for help. That's the most important thing.
Absolutely. I think there's an element of just, as you rightly pointed out, like having a community, which doesn't have to be through a particular pathway of you have to do this program and then you'll be able to raise capital. Yeah, I think that's a really, really important point. There was also a question about, would we have done anything different when we got started with our funds? I'm sure I would have done many things different. All these small micro decisions that you have to make add up. Anything standing out, Victoria, Barbara?
Yeah, I think to Victoria's point, I started off with a partner that we weren't really aligned. So I definitely would not have done that. I think I would have started off properly with the right partner or on my own. I mean, sometimes it's better to be on your own than to be with the wrong partner, frankly. But yeah, I think that was a big decision that I would have changed if I had to do it again. Another thing I would say, just to be very frank about this game, is I think there's some things that fundamentally you should just bring to the table that if you don't have it, it just makes your life really difficult. Whether it's you have, access to some level of financial resources to be able to maintain yourself as you're setting up a fund. I didn't realize the financial sacrifice of setting up a fund, frankly. And if I had to do it again, I would have totally approached it differently, from a financial standpoint. So I think going into it with real expectations that this is a financial sacrifice, so that you could prepare for it in different ways that you have to, whether it's getting working capital, warehousing, what have you. I think it's key. And some of these programs can do that or not. But that's, I think, and if I had to do it again, I would have had to change that mindset around the financials. Yeah, I'll just pause there because I'm sure others have more interesting.
Well, I think I'm glad I didn't know how long of a road it was going to be fundraising. But I guess that's the thing to know. It's a really, really, really long road. And so to Barbara's point, be prepared financially. To all of our points, you know, have people there who can pick you back up emotionally and psychologically when needed. And remember that you're playing a long game. So the no you get today might not be a no a year from now, and you will be raising a year from now. So, you know, maintain those relationships. It's all about building relationships. We're always thinking about fund 2 and fund 3. And so, you know, just kind of always remembering that there's this much longer road that we're on, and that helps, I think, as well.
Yeah, to put some data around this, and I think this is honestly really relevant for GPs, emerging managers, but also for LPs to just know. I have had 345 calls for my raise, and I'm a mathematician, so I did the math up front, and I knew I was going to have to get to 500. And I knew the time that was going to take, and then throwing in a global pandemic in the middle of it. But I think that it is really important to be realistic about the work that needs to go into this. I'm actually curious if any of you have strong views on seeding deals, because this is where I see a little bit of the kind of old school traditional view of VC. You know, some of these seeding deals, they, you know, require you to even invest your incentive structure, you know, invest your performance fee, invest your carry. Do you have you had any experiences and that we can highlight for either emerging GPs or even LPs that are deploying these structures?
Yeah, so I was a venture partner for a VC firm that took money from one of these platforms. The platform is called Capria. They seed your fund and they take a percentage of your GP. Your question is that the right approach?
Yeah, I mean, are these the right ways to go? Because often, as you point out, kind of like with the financial need, you don't always have a choice, right? Like they do bring you a higher AUM much quicker in your process.
So getting that deal flow is so important. And I think if you need to get deal flow, it's definitely worth considering. Now, making sure that is the right brand that you want to be associated with. Sure. Going forward with your fundraising is also just as important. So you have to try to get both, because sometimes that could limit your ability to raise follow-on capital. But I mean, look, I think anybody who wants to take a percentage of people's GP, I have issues with it. I'm just like, come on now, we are playing this very high risk game and this is the only upside we have, stop. So it has to be fair. You know, some people can be very stingy with GP stakes. So it really has to be fair.
Well, I know somebody who's also raising a fund, and my associate, who's kind of my right-hand partner, Mathilde, turned to me and said, how is he paying for his expenses? How is he supporting, you know, the raise? Because she knows how we're doing that. And I thought that was a really informed question to ask, even though it was a simple one, which is, where are fund managers coming from? They're coming from positions of wealth. If they're not, you know, lucky to have a seeding deal up front that's going to pay them a reasonable salary. And so I think some of the economics of a fund manager actually should be rethought in order to allow for a greater, you know, section of our world and population to be represented as fund managers. Victoria, you were going to say one thing.
Well, no, as this was going, I saw a comment in the window that said it's good to know that, you know, we all go through what the entrepreneur goes through in terms of fundraising. And I just wanted to say, yes, I have so much empathy for founders because, and it's interesting I think founders sometimes don't remember that the VCs are out there fundraising, and especially for those of us in this emerging manager field, we are pounding the pavement and doing all the same, you know, things that you are. So there is a lot of empathy there for sure.
Yes,
it's interesting to remember that.
Arguably more when you know $200 million doesn't fall in your lap. So I think we're probably more aligned, and that does happen. So Rob, I'm going to round up with your question and then do just a quick quick round robin. Yes. So yes. Oh, thank you, Gale. You answered in the chat around management fees. I just want to say I feel so privileged to be here with you three and to be here with our listeners who have stuck with us throughout this whole conversation. We have had very little people drop off on a busy work day and a Monday. But let's just end with the last question from Danitha. From a mindset or psychological standpoint, how have we grown or changed as women since joining the VC ecosystem? I'll start off so that you all have time to think about your answers. For me, it has really brought me into a place of authenticity, of being so comfortable with myself as an investor. I always say I don't lose sleep at night over my investment strategy. I occasionally lose sleep at night over fundraising, be honest about that. But about my portfolio and the way that we work, it has created a vehicle where I can truly express my vision of how capitalism should be employed and deployed for equity in our world and still make money. And so it really has brought me into kind of my best self. Barbara, I'll go to you.
Yeah, I think as a woman, it has definitely showed the importance, basically what we always say women are good at, like the multitasking, the sort of the perseverance and the strength. I think all of that has come out from this experience of raising a fund and being a fund manager. It's really being able to do so many things at once because you're building a company, just like you guys are as founders. And being the perseverance, being able to listen to no's and to why are you doing this, and to, okay, I'm gonna not get the raise presentation selection process, all the no's and all the challenges, but being able to still wake up and keep going. I mean, that perseverance as a woman is powerful. And we deal with it personally with other things as women. So it really resonates even as a fund manager, and strength, being strong enough to change this industry, right? We are doing things that, and we're going against the larger funds. It is a competitive game. I find myself sometimes feeling like I'm competing. I'm like, about to get into a match with some people in the ecosystem, but let's not talk about that. But you know what I mean? Like sometimes it's a bit of a game it's a bit of a battle when you're trying to make changes in the industry and people are coming at you saying, why are you doing this? No, we want it this way. And you have to have strength. You have to, so I've had to, recognize that about myself. So yeah, I think this is a very, it's changed me a lot, and in a good way, as I mentioned.
Incredible. Gale?
I think for me, it's learning how to accept and embrace failure as part of the journey. 5 years ago, even, I wouldn't have told you like, oh, I remember being in this workshop and the moderator was like, let's reframe your thinking to like, I embrace failure. And I was like, I can't do that. But, once you go through so much stuff and you realize that you're here for a bigger reason. And your bigger reason is like, obviously to make a lot of money for your LPs, but it's to make an impact in whatever is important to you and to me and to all of us. And so I think that North Star is something where I've given myself more permission to focus on that. So, I'll be honest, earlier in my career, I just kind of ignored the fact that I would walk into a room and it would be harder because I was a woman. And I just started to try to focus on, okay, like what do other successful women do in order to make an impact? And so I've tried to just learn as much as I can. And now that I have a bigger platform and more experience, I have to be willing to stand up for things and to speak out for things. And I'm still learning how best to do that. But I think that's been an evolution that's been really fascinating over the last several years for me personally.
For sure. Victoria, I'll let you close us out.
Sure. So I came to venture in my 30s, and it was a career change for me. And I had an entrepreneurial journey, and I ran a social enterprise for 11 years prior to this. And so I had an interesting path to it. And in the very beginning, I completely had imposter syndrome. You know, I was like, who am I to be doing this? And what am I doing? And I have no idea what I'm doing. And I would say what's changed over the last, 10 years is that I have so much confidence now in what I do, humble confidence. I'm always learning, as you all mentioned, but it's amazing to have just grown in this career that I never had expected. I never planned to go into venture. I had a completely different career path that I thought I was going to pursue, and sort of almost fell into it. And it's been this amazing journey where now I look back and I've executed over 150 investments. I've formed over 60 SPVs. Like, it's amazing to be in this place where you just finally feel expert at something. It's like, it takes 10 years, but I'm there finally. And yet I'm still learning. And I am always getting inspiration from the entrepreneurs that we work with and always learning new things from them. So if anybody is considering it as a career, it's an amazing one. And it's always something new.
The growth mindset, which I think is something I really value too. With that, thank you, Victoria. Thank you, Gale. Thank you, Barbara, for joining me in this conversation. We plan to share it with the world through the Conscious Investor online magazine and on the YouTube channel. And I hope that everybody who is here shares it as well with their network. We really tried to make this passionate and inspiring, but also practical. And so I'm really grateful for your time today. Have a great day everyone, and thank you for being here.
Thank you, Eva. You're an amazing moderator.
Yeah, you did a great job. Thanks.
It's fun.
It takes talent. It takes talent.
It does take talent. I mean, no, it does take, I actually meant to say it does take passion and practice, but I actually think it's more about having a good conversation. And funny enough, sometimes, and I'm sure you all have to run, but sometimes the coffee talk afterwards or like the casual chat afterwards can be like the fun conversation as well. So anyway, would love to meet you all in person at one point, and thank you for your time.
Yeah.
Thank you.
Thanks,
Bye,
everyone.
guys.
Bye, everyone. Take care.